Good morning, students. We have already discussed what is capital structure, what do you mean by financial structure, what are the differences between capital structure and financial structure, and how to calculate EBIT, how to deduct interest from EBIT, what is EAT, what do you mean by EPS. So everything in the classroom we have discussed. And in addition to that, we have also discussed theories of capital structure, traditional theory, Modigliani and Miller theory, modern theory. So these are all the various theoretical concepts that we have discussed in the previous classes. Now we are going to discuss about leverage. Leverage means what? Lever. First you must know what is lever. Lever is nothing but it is a small tool which is being used to lift a very big article, very big objects. It is a tool, small tool, often we are using to move an object from one place to another place, to lift an object from one place to another place. Like that, in finance, leverage is used as a technique to measure the risk and return relationship of various alternative capital structures. In finance, leverage is being used for the purpose of measuring the relationship between the risk and return of various capital structures. Generally, leverage in case of finance is considered, is taken as, what is it, fixed cost. In the area of finance, the term leverage is used to describe the firm's ability to use fixed cost assets and funds to magnify the return to its owners. It has been defined by several authors as given below. According to James Horn, leverage is the employment of an asset or funds for which the firm pays a fixed cost or fixed return. In addition, J.E. Walter, who has defined leverage, it is a percentage return on equity to percentage return on capitalization. As far as the Esther Salomon is concerned, leverage is the ratio of net returns on shareholders' equity and the net rate of return to total capitalization. S.C. Kuchal, who has defined the leverage, which refers to meeting a fixed cost or paying a fixed return for employing resources or funds. Types of leverage. There are three commonly used measures of leverages in financial analysis. They are operating leverage, financial leverage. Number 3, combined leverage. There are three types of leverages. First, let us take operating leverage. What is the meaning of operating leverage? Operating leverage use of fixed cost in operation of your firm. What is fixed cost? As far as this operating leverage is concerned, it is totally related to fixed cost. What is fixed cost? A cost that remains constant forever. If you take a product, that product consists of two costs. One is fixed cost, another one is variable cost. What is fixed cost? The cost that remains constant forever. Whatever be the production, the cost will not go up or will not come down. It will remain constant forever. For example, salaries paid to the employees, permanent employees. Whether the business firm is earning profit or not, whether the business firm is earning higher amount of profit or low or incurring losses, whatever it may be, but the firm has to pay the fixed amount of salary to the employees who are working in the business organization. Like that, rent is the fixed amount that is to be paid to the owners of the building in which the business is running. That is fixed. When the firm is incurring loss, definitely the firm has to give the fixed amount of rent to the building owner. When the firm is earning higher amount, enormous amount of profit, even that time, the firm has to pay fixed amount of rent to the owner of the building. There is no increase of rent at the time of earning higher amount of profit. There is no decrease of rent at the time of the firm which is earning low profit or even incurring losses. The rent is fixed. So like that, there are a number of examples for fixed expenses the firm has to incur. So all these fixed expenses that remain constant forever. So this is called as what? Fixed cost. And another one is variable cost. So what is the meaning of variable cost? According to the production, volume of production, the cost will vary. Suppose when the production is increasing, the variable cost is also increasing. When the production that comes down, the variable cost also comes down. Correct? For example, what are the variable cost? Labor cost, material cost, direct expenses. That means direct material, direct labor, direct expenses. These are all the variable cost. Okay, for example, to manufacture a product, material is the cost of material is 5 rupees per unit. Cost of material is 5 rupees per unit. Cost of labor is 2 rupees per unit. So total variable cost, for example, 7 rupees. If you manufacture 1 unit, you have to spend 7 rupees. If you manufacture 2 units, you have to spend 14 rupees. If you manufacture 1,000 units, you have to spend 7,000 rupees. When the number of units produced goes to 10,000 units, the total variable cost comes to 1,70,000 rupees. Right? Sorry. Yes. Total variable cost comes to 70,000 rupees. So this is what variable cost. What is total cost? Total cost is equal to fixed cost plus variable cost. For example, a company which manufactures 1,000 units of a product X, the fixed cost is 10,000 rupees. Variable cost is 7 rupees per unit. Total number of units produced, as I already told, 1,000. For 1,000 into 7 is equal to 7,000 rupees. Now the total cost comes to 10,000 fixed cost plus 7,000 variable cost. So totally 17,000 rupees. What is the cost per unit? That is 17,000 units divided by 1000 is equal to rupees 17 is the cost per unit. Okay. Now let us increase the production from 1000 units to 2000 units. Right? 1000 to 2000 units. What is the fixed cost? Fixed cost that remains constant forever. That is 10,000 rupees. So what is the variable cost per unit? 7 rupees. Number of units produced 2000 units. So 7 into 2000, 14,000. 7 into 7 rupees per unit into 2000 units produced is equal to 14,000. Okay, 14,000 rupees. That is the variable cost. So what is the total cost? 10,000 plus 14,000 is equal to 24,000 rupees. Okay, so 24,000 is the total cost. So what is the cost per unit? 24,000 divided by 2000 units is equal to rupees 12 per unit. Okay, you see that? Rupees 12 per unit. Right? Previously, when the number of, in the first case, only 1000 units are produced. What is the cost per unit? 17 rupees. Now, in the second case, the production is increased from 1000 to 2000. Right? What is the cost per unit? That is 12 rupees. Now, you see this, with the help of this example, you can understand when the number of units produced are increased, automatically the cost per unit that comes down. Right? What is the reason? Here the fixed cost. Fixed cost is the lever. That lever is being used for increasing the profitability of the business organization. Okay, right. Now let us see the formula for operating leverage. Operating leverage is equal to contribution divided by EBIT. What is contribution? Before that, you must know what is sales. Sales is equal to fixed cost plus variable cost plus profit or minus loss. Right? Okay. What is contribution? Contribution is equal to sales minus variable cost. Sales minus variable cost. So sales minus variable cost is equal to what is it? Fixed cost plus profit or minus loss. Okay. So what is EBIT? EBIT is equal to earning before interest and taxes. It is otherwise called as operating profit. EBIT is otherwise called as operating profit. Okay, what is the formula for finding out operating leverage? Operating leverage is equal to contribution divided by EBIT. Okay. Next, degree of operating leverage. So what is the meaning of degree of operating leverage? The degree of operating leverage represents percentage change in the operating profit resulting from percentage change in the sales. It may be said as degree of operating leverage is equal to percentage change in EBIT divided by percentage change in sales. Okay. The degree of operating leverage depends upon the amount of fixed cost element in the cost structure. A firm is said to be a high degree of operating leverage if it implies greater amount of fixed cost and smaller amount of variable cost. On the contrary, if the firm incurs a greater amount of variable cost and a smaller amount of fixed cost, it produces a low degree of operating leverage. Once again, a firm is to have a high degree of operating leverage if it employs a greater amount of fixed cost and a smaller amount of variable cost. On the other hand, if the firm incurs a greater amount of variable cost and a smaller amount of fixed cost, it produces a low degree of operating leverage. Okay, the concept of operating leverage will be explained with the help of the examples. You see the examples. X Limited sells 1000 units of rupees 20 per unit. The cost of production is rupees 14 per unit. The firm has a fixed cost of rupees 1000. Assume that the sales of X Limited increases by 50%. The present and expected costs and profits would be as follows. There are three columns, particulars column, present particulars, next year particulars or the expected particulars. You see, sales, present sales how much? 1000 units at the rate of rupees 20 each, totally 20,000 rupees. Expected 1500 units at the rate of rupees 20, 30,000 rupees next year. Less variable cost that is given as 14 rupees per unit, totally 1000 units, so 1000 into 14 is equal to 14,000 rupees. Expected 1500 into 14, 21,000. So sales minus variable cost in the present situation, contribution is equal to 6,000. In future the contribution would be 9,000. Less fixed cost 1,000 in both the categories. Then what is operating profit, that is EBIT? Then contribution is equal to, that is fixed cost plus profit. If you deduct fixed cost, the balancing figure is operating profit, that is EBIT. That is in the present situation rupees 5,000. In the expected, that means in the next year it would be 8,000. Degrees of leverage is equal to percentage increases in EBIT divided by percentage increases in sales. Both are same, percentage change in EBIT divided by percentage change in sales. Okay. Now let us find out the percentage increases in EBIT is equal to EBIT how much for the current year, that is 5,000. How much it has been increased? 3,000. For 5,000 increasing is 3,000, right? Into 100 is equal to 60%. Then percentage increase in sales, the current sales is 20,000. How much has been increased? 10,000 rupees. So 20,000 is the current. Increase 10,000 into 100 is equal to 50%. So degrees of leverage is equal to, percentage change in EBIT, that comes to 60%, divided by percentage change in sales, that is 50%, that is 1.2%. 1.2 times. What does it mean? The degree of operating leverage is 1.2, means that 1% increase in sales would result in 1.2% increase in operating profit. That's a fact. If sales is increased by 1%, the operating profit will increase 1.2%, it means, right? Okay. Financial leverage. Financial leverage occurs when a firm uses fixed interest or fixed dividend bearing securities, that is debentures and preference share capital, along with the owner's equity to improve the return on equity investment. The fixed financial charges such as interest on debentures, preference dividend, etc. do not vary with the operating profit, that is EBIT. These charges are to be paid regardless of the amount of EBIT available to pay them. After paying them, The remaining EBIT belongs to the equity shareholders. Financial charges is concerned with the effect of changes in EBIT on the earnings available to the equity shareholders. So therefore, it has been defined that it is an ability of a firm to use fixed financial charges to magnify the effect of changes in EBIT on the firm's earnings per share. So this can be determined by using the formula. What is that? Financial leverage is equal to EBIT divided by EBT. So what is EBIT? EBIT is nothing but operating profit, that is earnings before interest and taxes. EBT, earning before taxes. Next, degrees of financial leverage. So what's the meaning of degrees of financial leverage? The degree of financial leverage is the percentage change in taxable profit as a result of percentage change in operating profit. That is, the ability of the firm to utilize fixed financial costs in order to magnify the effect of changes in EBIT on EPS of the firm. The degrees of financial leverage can be computed as DFL is equal to percentage change in EPS divided by percentage change in EBIT. Okay, the financial leverage is favorable when the firm which earns more on the investments financed by sources having fixed charges. It is clear that the shareholders gain in a situation where the firm which earns a high rate of return and pays a lower return to the suppliers of long-term funds. So financial leverage in such cases is therefore called as trading on equity. So this trading on equity, which we can see with the help of a solution that we will discuss later. What is the meaning of combined leverage? Operating leverage measures percentage change in operating profit as a result of percentage change in sales and financial leverages, which measures percentage change in taxable profit on EPS due to percentage change in operating profit. Whereas operating leverage indicates the degree of operating risk, financial leverage indicates the degree of financial risk. Both these leverages are closely concerned with the firm's capacity to meet its fixed cost. If both these leverages are combined, the result obtained will reveal the effect of changes in sales or changes in taxable profit on earning per share. Combined leverage establishes the relationship between sales, that is contribution, and the corresponding variation in taxable income. It can be computed by the formula, what is it? Combined leverage is equal to operating leverage into financial leverage. So what is operating leverage? What is the formula for operating leverage? Contribution divided by EBIT. What is the formula for financial leverage? EBIT divided by EBT. So what is the combined leverage? Contribution divided by EBIT into EBIT divided by EBT. The computation of combined leverage can be explained with the problems that we will discuss now. Okay, let us work out one problem. XYZ Limited produced and sold 1 lakh units of a product at the rate of rupees 10 per unit. For production of 1 lakh units, it has spent a variable cost of rupees 6 lakhs at the rate of rupees 6% and a fixed cost of rupees 2,50,000. The firm has paid interest of rupees 5,000 at the rate of rupees 5% on rupees 1 lakh debt. Calculate operating leverage. Once again, you see that how many the XYZ Limited is a company that has produced and sold 1 lakh units of product at the rate of rupees 10 per unit. Okay, total sales 1 lakh units at the rate of rupees 10 per unit. For production of the 1 lakh units, it has spent a variable cost of rupees 6 lakhs at the rate of rupees 6 per unit and a fixed cost of rupees 2 lakh 50,000. The firm has paid interest of rupees 5,000 at the rate of 5% on rupees 1 lakh debt. Calculate operating leverage. What is the formula for operating leverage? Contribution divided by EBIT or operating profit. Okay, see that sales revenue, total sales 1 lakh units at the rate of rupees 10 lakhs, less variable cost 1 lakh, variable cost comes to rupees 6 at the rate of 6 for 1 lakh units, that is 6 lakhs. Contribution is equal to 10 lakh minus 6 lakhs, that is 4 lakhs. So less fixed cost rupees 2 lakh 50,000, EBIT getting 1 lakh 50,000. So operating leverage is equal to contribution divided by EBIT or operating profit, that is contribution 4 lakh rupees divided by EBIT, that is 1 lakh 50,000, is equal to 2.66 times. And then another problem, from the following particulars of ABC Limited, calculate degree of operating leverage. Particulars are given: previous year, current year. So current year sales, variable cost, fixed cost, previous year sales, variable cost, fixed cost are given. Okay. Sales revenue previous year, that means 2003 and 2004. Sales 10 lakh in 2003, current year 2004 12 lakh 50,000. Last year variable cost last year 6 lakh, then current year 7 lakh 50,000. Fixed cost last year 2 lakh 50,000, current year 2 lakh 50,000. There is no change. Then you find out sales 10 lakh for the year 2003. Then for the year 2004, 12 lakh 50,000. So percentage change in percentage change, 2 lakh 50,000 divided by 10 lakh, that is 25%. Less variable cost 6 lakh previous year, current year 7 lakh 50,000, then 25%. Contribution, sales minus variable cost, that is 4 lakh for the year 2003 and 2 lakh 4,000 for the year 2004. Change is 25%. Then fixed cost, less fixed cost, 2 lakh 50,000, 2 lakh 50,000 for both years, because the fixed cost that remains constant forever. EBIT, sales minus variable cost contribution minus fixed cost, EBIT, that is 1 lakh 50,000 for the year 2003 and 2 lakh 4,000 for the year 2004, 2 lakh 50,000. Formula is percentage change in sales divided by percentage change in EBIT. Percentage change in EBIT divided by percentage change in sales. Percentage change in EBIT 66.67% divided by percentage change in sales 25%. Operating leverage 2.667 times. That means what? 2.667 indicates that when there is 25% change in sales, the change in EBIT would be 2.667 times. So that's a problem. Next, problems related to operating leverage and financial leverage. A firm has sales of rupees 1 lakh units at the rate of rupees 10 per unit. Variable cost of the produced product is 60% of the total sales revenue. Fixed cost is rupees 2 lakh. The firm has used a debt of rupees 5 lakh at 20% interest. Calculate the operating leverage and financial leverage. Okay. Sales revenue, that is totally how many units? 1 lakh units. The price is 10 rupees per unit. So 10 lakhs. Less variable cost, 10 lakh into 60%, that is 6 lakhs. So sales minus variable cost is equal to contribution, that comes to 4 lakhs. Less fixed cost, rupees 2 lakh, that is given in the problem. Then if you deduct fixed cost, you can get what? EBIT. Less interest. How much is the interest? 20% is the interest. So 20% on rupees 5 lakhs is the interest. Okay, how much? That is 1 lakh. Then if you deduct rupees 1 lakh from 2 lakh EBIT, then you can get rupees 1 lakh, that is what? EBT, that is earning before tax. So for operating leverage, we need the variables, what? Contribution and EBIT. So contribution divided by EBIT, that is 4 lakh is the contribution, 2 lakh is the EBIT. So 4 lakh divided by 2 lakh is equal to 2 times. Next, financial leverage, EBIT divided by EBT. EBIT we have found out, that is rupees 2 lakh divided by EBT, that is rupees 1 lakh, that we have found out. So EBIT divided by EBT is equal to 2 times. So another problem, from the following particulars of PQR company, calculate operating and financial averages. Financial leverages. The company's current sales revenue is rupees 15 lakhs and sales are expected to increase by 25%. Rupees 9 lakh incurred on variable expenses for generating rupees 15 lakh sales. The fixed cost is rupees 2,50,000. The company has rupees 20 lakhs equity share capital on rupees 20 lakhs, 10% debt capital, rupees 10 per equity share on 50% tax rate. Now, solution for the problem, calculation of EPS. You divide the 4 columns, particulars, current position, expected change in future, percentage of change. Sales revenue, that is 15 lakhs, that is given in your problem. The expected change is how much? 25%. 25% on 15 lakhs, that comes to 3,75,000. So 15 lakh plus 3,75,000 is equal to 18,75,000. Less variable cost. The variable cost, that is 9 lakhs. 9 lakhs. So what will be the increase of variable cost that we have to find out? You see the working notes, that is number 1, variable cost to percentage of sales. Variable cost is equal to total variable cost. Variable cost in percentage is equal to total variable cost divided by sales into 100 is equal to total variable cost 9 lakh divided by sales into 100 is equal to 60%. Increase in variable cost is equal to 60 by 100 into 18,75,000, that is 2,25,000. So that the total variable cost, total expected variable cost in future will be 9 lakh plus 2,75,000 is equal to 11,25,000. Right, now 11,25,000. So if you deduct say variable cost from sales, then you will be getting what? Contribution. So on contribution, how much? That is 6 lakh in the current position. The expected change comes to rupees 7,50,000 less fixed cost that is given in your problem. The fixed cost that remains constant forever, that is 2,50,000. In future it would also be 2,50,000. So if you deduct the fixed cost, you can get what? EBIT, that is operating profit, that comes to 3,50,000 in current position, and expected would be 5 lakh. Then so how much is in percentage change in EBIT? That is 3,50,000. Expected change is 5 lakh. So how much? 1,50,000 has been increased. So that for 3,50,000, 1,50,000 has been increased into 100. That comes to rupees 42.86%. Then from the EBIT, we have to deduct interest. Interest how much? 2 lakh. That is given in the problem. So if you deduct interest, you can get what? EBT, earning before tax. That is 3,50,000 minus 2 lakh in the current position. That comes to rupees 1,50,000. And in the expected change, 5 lakh minus 2 lakh as a interest, then we'll be getting EBT 3 lakh. Then less tax, that is 50%. EBT, earning before tax 1,50,000, 50% tax has to be paid, that is how much? 75,000. Then 3 lakh, 1,50,000, 50% is a tax, that comes to 1,50,000. Then if you deduct this, there is no preference dividend. The remaining amount that is available to the equity shareholders. Okay, so how much is the EPS? How much is the EPS? That is 75,000 divided by 2 lakhs. 75,000 is the amount available to the equity shareholders, divided by 2 lakhs. 2 lakh. 2 lakh means what? 2 lakh equity shares. That comes to 0.375. Then in case of expected change, that is in future, the amount available to the equity shareholders comes to 1,50,000 divided by 2 lakh. That comes to 0.75. 0.75. Okay, what will be the change? 3.75. See the notes, EPS notes, working notes. That is earnings available to equity shareholders divided by number of equity shares outstanding. Current position 75,000 divided by 2 lakh, 0.375. Expected change 1,50,000 divided by 2 lakh equity shares, that is 0.75. Operating leverage, contribution divided by EBIT, that is or percentage change in EBIT divided by percentage change in sales. That is what? 6 lakhs divided by 3,50,000 or 42.86 divided by 25. Then financial leverage, that comes to EBIT divided by EBT, that is percentage change in EPS divided by percentage change in EBIT, that is 3,50,000 divided by 1,50,000 or 100 divided by 42.86. is equal to 2.333 times application of financial rule. It is helpful to know how EPS would change while change in operating profit. It is useful in measuring financial risk. Okay. Next, combined leverage problem. VST Corporation has sales of rupees 40 lakhs. Variable cost is 70% of the sales and fixed cost is rupees 8 lakhs. The firm has raised 20 lakhs funds by issue of debentures at the rate of 10% per annum. Compute operating, financial and combined leverages. So total sales revenue, that is 40 lakhs. Variable cost, that is 70% on 40 lakhs, that comes to 28 lakhs. Contribution, sales minus variable cost, that comes to rupees 12 lakhs, less fixed cost 8 lakhs. So if you deduct fixed cost from contribution, you can get 4 lakhs, that is what EBIT. So if you deduct interest at the rate of 10%, then it comes to rupees 2 lakh. Then if you deduct rupees 2 lakh from 4 lakh, you will be getting EBT. How much? That is 2 lakh. Right? Okay. What is the operating leverage? Contribution divided by EBIT. That is 12 lakh divided by 4 lakh 3 times. Financial leverage, EBIT plus EBT. EBIT divided by EBT. That is 4 lakhs divided by 2 lakhs is equal to 2 times. Combined leverage, that is operating leverage multiplied by financial leverage, that is 3 times into 2 times, that comes to 6 times. Okay. So this is a problem, and in addition to that, you saw the table also, the effect of operating leverage, financial leverage and combined effect. Then if operating leverage is high, financial leverage is high, so what will be the combined effect? This combination is very dangerous policy which should be avoided. Which one? If both operating and financial leverage is high, the combined leverage, combined effect of this operating and financial leverage is very dangerous policy. It's a very dangerous policy which should be avoided. If both are low, that is operating leverage is low, combined leverage is also low, this combination is very cautious policy and not assuming risk. Okay. If operating leverage is high but financial leverage is low, this combination is adverse effects of operating leverage and are taken care of by having low financial leverage. Low operating leverage is low but financial leverage is high. This combination is an ideal situation. The company can follow aggressive debt policy. Okay, that's all. Now I would like to give some of the important questions, 2 more questions, and some of the important essay type questions which you can expect in your semester examination.